Hi, everyone. Welcome to it's beginning of summer, but it feels like the middle of summer here in the middle of June 2025. The hot weather is here, and maybe the hot market takes are here. We'll find out in the next half hour together. So excited that you're all joining us. Way of introduction for anybody where this is your first time. I'm Jarrod Musick. I'm the CEO here at Destiny Capital, and I serve on the investment committee alongside Tim Doyle. So my role is really to help be a thought partner to Tim, who drives all of our deep research and thinking on all things investments and markets. Tim?
Yep. Yeah. Thank you, Jarrod. My name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital. I oversee all things related to investment management, as Jarrod indicated. That includes capital market research, fund due diligence, manager selection, portfolio construction, trading, and more, as well as content like webinars and my monthly blog and quarterly Chief Investment Officer mailbag, where I answer client questions directly. So happy to be here. We've got a lot to talk about, some new updates to get into related to tax and markets and all that good stuff. So looking forward to getting everybody caught up.
We always have to start with our disclosures. So heavily regulated industry for lots of good reasons, but we have done our very best to make sure that everything we're sharing with you today is timely and accurate. Please don't make any irrevocable decisions without talking with your wealth advisor, CPA, attorney, somebody who's qualified to help you map what we're talking about over to individual decisions. If you already work with us and your team, fantastic. Please reach out to them if you want to chat about any of these. And Destiny Capital is a registered investment advisor. I don't think we're going to talk about any specific securities today, but on some of these we do. And in some cases, either our team and or our clients have investments in said securities. So with that, let's move forward. We spent quite a bit of time in our prior edition talking about, well, there's a big tax bill that's going to be working its way through. We don't really have a lot of insight into that. Well, fast forward a few weeks, and now we actually do. So we're going to dig into that. We essentially have the initial version, which has come from the House of Representatives. So the way our system is set up is that all matters pertaining to revenue have to originate in the House of Representatives, and then they go over to the Senate. The Senate tends to also draft their own version of the same legislation, and then they kind of negotiate and figure out which version they're going to try and push forward. So a lot of what we're seeing here is the House version, and we also have some insight into the Senate version. So Tim, do you want to walk us through what we know and what we think is likely to come out of this process as it works through?
Yep. Yeah. The one big beautiful bill. We finally have some details here, as you mentioned. So we just wanted to walk high level through some of the key features that we're looking at and some of the ways that it might impact investors. So first and foremost, it extends the tax cuts from 2017 for all income levels. That's been expected. No surprises there. And the corporate tax rate is cut from 21% to 15% for domestic production income. We've got a slight increase in the standard deduction, $1,000 for individuals and $2,000 for married filing jointly filers. We've got a 4K bonus to the standard deduction for taxpayers 65 and up. I believe the Senate version has a $6,000 bonus. Again, a lot of this is going to be subject to tweaking. One in particular that's going to be subject to tweaking is the state and local tax deduction. The Congress had passed a version with a $40,000 cap, whereas currently that's at $10,000, and I think in the Senate version they are either going to strip that out entirely or reduce that significantly. So that's one we're going to be keeping an eye on as well for those of us, including myself, in states with high income taxes. So we've got no taxes on tips to $25,000 or on overtime pay up to 20% of regular wages, a $10,000 interest deduction for car loans. This is an interesting one for final assembly in the United States, and child tax credit is listed at $2,500. Again, the Senate version has tweaked that as well. So still, as you indicated, a lot of negotiation still to go on here. One thing that really stands out to me is the fact that this doesn't necessarily simplify tax filing in any way. I remember just a few years ago we were talking about, hey, you could file your taxes on a postcard, right? I don't know if you remember those days, Jarrod. That's clearly not going to be happening with a lot of what's being proposed here, particularly the no taxes on tips. That's going to cause, I think, a tremendous amount of confusion, and that could be potentially subject to change. It's difficult to see how, you think if you have a McDonald's on one corner and a Joe's Burger Shack on another corner, McDonald's pays entirely in wages and Joe's is primarily in tips. Well, Joe's Burger Shack employees are going to come out way ahead in that scenario, you would think, with the ability to have pay no taxes on their tips versus the wages that are being paid on another side. So a lot of gray area to be ironed out in some of those instances, and it may add some confusion there. But one area that definitely jumps at us in looking at these proposals, both in Congress and in the Senate, is the fact that they are asking for an increase in the debt limit. And in the case of Congress, they are looking at a $4 trillion, trillion with the T, trillion dollar increase to the debt limit, whereas the Senate proposal calls for a $5 trillion increase. And as we've talked about previously, a lot of our concerns are focused around the federal deficit, the deficit spending of the federal government, and the overall debt levels of the United States as a whole. And this tax proposal, and we'll get into this on the next slide, does little in the way to solve those issues. So at a high level, that's kind of what we're looking at. We'll get into kind of the market reaction or the expected market reaction on the next slide. Jarrod, anything else you wanted to highlight, any of those bullet points or any of the key features that we should be thinking about or concerned about, either as individual tax filers, as business owners, and what have you?
Yeah, I think I want to point to one of the comments that you made, which is this does not make tax compliance any easier or more streamlined, which I think is something that as a taxpayer, we all really want and would advocate for. I definitely philosophically come down on the side of the spectrum where, the tax code should be used for raising revenue for the government in the way that least distorts the functioning of the economy. So a lot of people fundamentally disagree with that and think that the tax code is a series of sticks and carrots in there to nudge behavior into certain ways. So maybe I'll never get my wish that we just make this as simple as possible. It's looking increasingly that way. So that's just a philosophical comment. The state and local tax deduction cap is going to really matter for our business owner clients. So, that was essentially introduced so that effectively taxpayers in Wyoming with zero state income tax would not be funding the federal government at a higher clip. We're essentially subsidizing those of you in New Jersey who paid a lot of state income tax, but then got to deduct that against your federal income tax. So I think that was the original intent there. And it's turned out to be fairly unpopular when people historically have been able to deduct their state and local income tax payments. They really don't like not being able to do that. It raises their effective federal rate, which was part of including it in the original 2017 bill, was to raise more revenue to provide more room for different tax cuts in different places. So in response, a lot of states have, or a vast majority of states have created the PTE pass-through tax entity strategy, where you can essentially choose to pay individual taxes through some of these pass-through entities, LLCs and S-Corps, and sort of work around that deduction. So the draft that we're seeing from the Senate currently eliminates PTE as a strategy. So we'll keep you informed as we know more about that, but that's likely to be a significant adjustment for owners of small businesses that are structured as pass-through entities. So just a couple of call outs there. We're going to touch a lot on the debt and deficit on the next slide. So I think, as we look at just the size of the issue, and we've continued to touch on this, and I think we will, our brains have difficulty conceptualizing how big $1 trillion actually is. So I think percentages are really helpful. And Tim, you've created this great chart in the lower right-hand corner there. So we're projecting that the deficit is going to be 27% of total spending, which means we're essentially borrowing a quarter for every dollar that we're putting out the door. So, with that as kind of a setup, Tim, do you want to walk us through the details here?
Yeah, well, let's start with, I guess, what you could categorize as the good related to this, and that's the stock market reaction. So tax cuts are a form of stimulus. It's fiscal stimulus, right? It puts more dollars in the pockets of U.S. corporations, in U.S. taxpayers, for them to consume, to expand, do whatever they want to do with those dollars. And that can generally provide tailwinds to the economy and subsequently the stock market. So that's a good thing. And we may already be seeing that play out in the stock market. We've seen quite a rebound from the April lows when we were in the depths of the tariff uncertainty. And we're still in quite a bit of the tariff uncertainty realm right now. But part of the reason that markets have reacted so positively since then is because we've had strong earnings in the stock market, and we've gotten news about tax cuts, corporate tax cuts and individual tax cuts that should, in a perfect world, provide some tailwinds for U.S. stocks. So we believe some of that tailwind has already hit. So it could continue to push stocks even higher, but for now we're seeing a positive market reaction to the tax cuts and to earnings and to the general environment and the health of the overall economy that we're seeing right now. Where we could see a different story is in the bond market. And as some context, when we're talking about these tax cuts and what it's expected to add to the federal deficit over the next 10 years, we've got three different sources here running estimates. So we've got the Congressional Budget Office, the Yale Budget Lab, and the Penn Wharton Budget Model. And each expect this tax cut bill to add between $2.4 trillion and $2.8 trillion to the federal deficit over the next 10 years, meaning that deficit is not shrinking over time. If anything, it's set to expand and expand even greater. That means to cover that deficit, the U.S. government will need to continue to borrow to cover this persistent deficit, which will in turn cause an additional surge in the U.S. public debt over time. So if you look at, we can look at some of the charts. One of the charts to the top right, and this just shows the Tax Cuts and Job Extension and the federal net deficit, accumulated deficit, and you could just see the red line, how that really increases that over the next few years, the forecasted years. But the area I really wanted to focus on, as Jarrod alluded to on the bottom right, is the federal budget and the net interest expense. So the cost of servicing this debt is growing. So we have to pay interest on this debt to those that are purchasing U.S. treasuries. And that is highlighted there in red as the net interest expense, currently $952 billion, or 14% of the 2025 fiscal budget. That's a big line item, and it's growing. So what if that becomes 15%, 17%, 18%, 20% over time? Then it becomes a larger line item, budget item than Social Security. So we're doing nothing but paying our tax dollars towards that net interest expense, whereas it should be going to improving the economy, improving infrastructure, and so forth. So I wouldn't consider those dollars necessarily well spent. And that's just one issue to be mindful of. We could also see, because we're going to be adding so much debt into the bond market year over year, bond investors could essentially revolt and say, hey, you know what? We're not that, $2 to $3 trillion every year is a lot for us to absorb. And your balance sheet is growing a little bit more unhealthy, the United States. You guys are spending beyond your means. Your debt to GDP ratio is growing. Therefore, you're more risky to borrow from. So we demand higher interest rates in order to incentivize us to buy your debt. Then we could see the 10-year Treasury and 30-year Treasuries climb. Let's call it from 4.5% to 5 or 5.5% or 6%. What happens then? Well, then we look back at the chart to the bottom right there again, and that net interest expense continues to expand and grow and grow and grow because we're paying higher interest rates on that debt to service that debt. This could also have an effect on the U.S. economy because this would raise the cost of borrowing. So the 10-year Treasury is often considered a baseline rate for all things like, mortgages, auto loans, student loans, things like that. Just think of broad ways you borrow. It could be corporate debt and so forth. So if that baseline rate goes from 4.5% to 5.5% or 6%, you're going to have to stack on an additional premium for mortgage. So if it's at 5%, maybe mortgages climb to 8% or something along those lines. Maybe student loans climb from 5.5% to 7.5%, 8.5%. That means U.S. consumers are spending more of their dollars on servicing their own debt, and that's less cycle through the economy. The economy shrinks, or people aren't borrowing as much. The housing market slows down. Cars aren't sold because auto loans are too expensive. We see a general slowdown in the U.S. economy, and that's truly not a good thing. So kind of the trickle-down effect of this accumulated debt will be seen across the broad spectrum of the economy if we continue down this path, and if we don't see the federal deficit addressed meaningfully in the coming years. We always say, Jarrod, this isn't a tomorrow issue. This isn't a 1-3 year issue necessarily, but we're essentially going to get to the time, and I think it may take a bond market revolt to incentivize policymakers to make some of these changes. But when that happens, what do you do? So we don't want to find ourselves in that situation, which is why we're talking so much about this, because we do think it's such an important issue that us as taxpayers need to be mindful of, because it not just affects our taxes and what we're paying in taxes year over year, but it will affect portfolios, will affect the broad economy, families, friends, children, grandchildren, and all that stuff. So, Jarrod, I'll stop there. Anything you wanted to add? I know that's a lot, Jarrod, to digest. Anything you want to highlight or go through there specifically?
Yeah, I think we're talking about this, and it sounds very doom and gloom, and I think we're just trying to express the seriousness of the issue and the size of the issue. That if we get to the point, even currently, we're issuing $1.9 trillion of new debt, in addition to the debt that matures, which we don't have the ability to pay off. So we refinance it by issuing new debt to refinance the old debt. There is just a real limit in terms of how much the bond markets can actually absorb and finance. And we don't really know what that limit is. But we do know that the more pressure we're putting on that to continue to refinance our debt and finance new debt, it raises the risk that the bond market is going to be unable or unwilling to absorb it at current levels or at current interest rates. So everything that you just talked about, Tim. And I think when we look at the chart in the upper right hand side, you can really see that our debt to GDP ratio prior to the great financial crisis was extraordinarily manageable, below 40%, and pretty much what you would expect for a non-wartime economy. You can see, debt to GDP last hit these levels at the conclusion of World War II. And that really makes sense. You're issuing bonds and war bonds and different things to build destroyers and tanks and, K rations and all of those things. And that debt was paid off over time. But we have great financial crisis, and we did a lot of quantitative easing. We did other things and really ramped up that debt load. And then we hit 2020 and COVID and a bunch of one-time initiatives again that increased that debt load. But there's really been no brakes that have been applied in the last 18 years to the debt spending and the deficit spending. And it's all been fine until now. But when we're spending almost $1 trillion every year in interest on the national debt, that crowds out other things. And so these very painful conversations that we've been having, we're starting to have at the federal level about what do we do around Medicaid? Well, Medicaid is still only 9% of the budget. So even if we eliminated Medicaid as a program, it doesn't fix the problem. Even if we eliminated Medicaid and Medicare, if we just said we don't do healthcare at the federal level anymore in any way, it still doesn't solve the problem. So I think there are our point that we're making here is we don't know when the bond market is going to start imposing some external brakes on the path that we're on, but it will come at some point in all likelihood. And we are likely going to look at some much more difficult conversations around federal spending and federal tax rates. One last thing to highlight on the good side here, when we look at tax payments at the federal level, the top 1% of income earners pay 46% of all individual income taxes, which is our single largest source of revenue. And the bottom 50% currently pays 2% of all federal income taxes. So we have a very interesting design on our tax code. We have a very interesting design around spending. I think we all understand that this is not sustainable forever. And at some point, we're going to need to see changes. So.
And a few more things to add, Jarrod. If you think about, we've been on this trajectory for quite a long time. So why the urgency now, right? Right after the great financial crisis, we went through a decade or more of ultra low interest rates, right? So the cost of borrowing was pretty low. So when the 10-year Treasury is at 1.25, that's a little bit more manageable than at 4.5% because the interest expense is a bit lower. So you can get that, I think the federal government got a little bit addicted to that sugar high of borrowing because it's like, well, this is basically free money. It's like those who refinance their mortgages, when interest rates, when mortgage rates were below 3%, you're like, hey, this is like free money. This is great. Those days are over, right? So we're in a bit of a different environment. And that's just why I think this is coming a little bit more of ahead, even though we've been on this path for 15 years. So it's just something we need to highlight. And another thing to highlight is that we're mindful of this. So as investors, we're looking at alternative asset classes, ways to kind of buffer portfolios, client portfolios from shifts in interest rates. So we've been on search for a lot of investment opportunities that are not as sensitive to interest rate movements, like you might see in corporate bonds and treasuries and so forth. So one area I would highlight is private credit that we're very excited about, that we've introduced to a lot of our client portfolios. There are some liquidity features that come with that, or illiquidity features that come with that type of investment, but it also pays an extraordinary yield, and the majority of the underlying credits are floating rate. When credits are floating rate, that means they are not sensitive to movements in interest rates. And that is a very appealing feature. When you think about risks moving ahead, like a spike in interest rates if bond markets become a little bit more volatile, because that could cause prevailing bonds to decline in price if we see interest rates move higher from there. So private credit is something we're excited about. Other alternative asset classes are things that we're digging into heavily. Even you could even look at gold, that has had quite a run because that's been very, very popular from different central banks across the globe. That's been really driving up the price. So anyway, but I want to cut that there. I don't want to get too into the weeds, but we are mindful of this, believe me, and we are thinking of constructing portfolios in ways that can buffer against some of this potential volatility that we may see down the road. So just wanted to highlight that as well.
Yeah, we really spent the years between 2022 and late last year talking about inflation every single time we did one of these, and I fear that we may have debt deficits and federal revenue and expenditures as kind of our theme for the next few years. So if you found this tedious, I apologize. We'll try and make it more fun in the future, but this topic is likely going to be a persistent one for us.
We find it tedious as well, so we're there with you.
Exactly. Well, I think shifting that mindset again over to the lens as investors, what have we seen so far this year with things outside the US and kind of what's driving the returns in that area?
Yeah, it's been fascinating. I think, the old saying, I didn't have this on my bingo card. I don't think any investment managers, when we were looking at projections moving into 2025, had global stocks experiencing a bit of a boom and having their moment in the sun after 15 years of drastic underperformance relative to US stocks. So We're starting to see that. We're seeing that in the MSCI All Country World Index, ex-USA. That means it excludes the USA. So basically, everybody else except for the USA, all other stocks in aggregate, are up 15.75% on a year-to-date basis. Then we have the MSCI Emerging Market Equities. When you think of emerging markets, think countries like India. Even China is considered an emerging market and is still kind of lumped into that category, up just over 12.5%, whereas the S&P 500 is up 2.34%. The S&P 500 has experienced quite a bit of volatility. You can see that in the charts at the top right. So that's where you see the path of the S&P 500 in kind of that blue, light blue color. Emerging markets in orange, and in purple is the All Country World Index. So pretty drastic outperformance. We haven't seen these performance spreads between U.S. equities and global equities in quite a long time. So I think it's been a surprise to many, because it's interesting to dig into what's really driving this. So investors may see this and say, well, why don't I have 30% of my portfolio in these stocks, and why didn't you do that on the 1st of January? And I think there's a few reasons for that, and some of these reasons why we're not shifting significant client capital necessarily to international equities is because we have still a tremendous amount of uncertainty around tariffs and trade and the impact that's going to have on the global economy. So we're in kind of a wait and see mode as it relates to what tariffs might look like in the Eurozone. Will they be we have a little bit more. We've seen some resolution, I guess you could call it, a mini trade deal between the U.S. and China. Tariffs remain in place with Canada and Mexico, but the rest of the world really is in question. And we saw drastic tariffs announced by the Trump administration across the globe on Liberation Day in early April. So a tremendous amount of uncertainty. We don't know who the winners and losers are really going to be there, which tariffs are going to be permanent. Will we have a 10% universal tariff, or will it be country by country like it's been? Yeah, it could be any and all of the above. And the issue is we don't know. So it's difficult to allocate capital to regions with that level of uncertainty hanging over our heads. It's also important to note in areas, especially the Eurozone, the regulatory environment is incredibly stringent. That's why Silicon Valley is so popular and is such a hub for innovation in the United States. A lot of global investors may just set up shop there because relative to Europe, the regulatory environment in the United States is much less onerous, and regulation or over-regulation can really hinder growth, expansion, all of the above, and make it difficult for companies to grow revenues, increase profits, and so forth. So that's another consideration to think about particularly when you're thinking about areas in Europe, and Europe has done particularly well on a year-to-date basis. We'll get into that a little bit more in just a second. But then you look at the sources of year-to-date returns. So this we see in the chart to the bottom right. So I've highlighted in red. This is the Eurozone that we're looking at. And on a year-to-date basis, it has over a 25% year-to-date total return. So you think, where is that return coming from? So ideally, as investors, where we want most of that return to come from is from earnings. So we want to see really strong earnings, and earnings would be represented by a purple bar in this particular bar chart. However, what we're seeing is not that, particularly in Europe. What we're seeing is the vast majority of returns coming from currency. So currency tailwinds. This is because we're looking at over 10% of the total return coming from the fact that the dollar has fallen significantly in recent months, and the euro has subsequently surged a bit. So that in turn provides tailwinds to international stocks relative to U.S. currencies, because when you own international stocks, you own them in their currency. So we would own them in euros in Europe, for example. So when you convert them back to dollars, you have more euros and dollars, so you get a tailwind, you get higher return, total return there. Then we look at the gray bar, which is an earnings multiple, or a multiple, excuse me. Multiples is essentially when we talk about, when we talk about the S&P 500, we talk about the price to earnings ratio increasing. And when the price to earnings ratio increases, that means that the S&P 500 is getting more expensive. What we're seeing here is the multiple is expanding, it's growing, meaning that investors are simply more willing to pay more per share than they have been previously. And that's expanding the total return because that's helping the price appreciation of those stocks as well. And then European stocks traditionally are very good dividend payers. So we could see dividends well above 2%, well above 3%, to be honest with you. So dividends are a contributor to total return. And so we're seeing that as a contributor of that 25+% total return. What we're not seeing there, I guess is my point, is earnings and earnings growth. So that's a cause for concern. What we want to see is earnings growth over time, particularly in Europe, to justify the price increases that we're seeing in the appreciation in European stocks. And it's just not there. And that's been my problem with European stocks for the last 15 years, is that the earnings growth has been absolutely tepid relative to the United States. If you're thinking of a line chart, the United States has been on an upward path, whereas the euro area has just been kind of moving sideways, up and down periodically, but not surging higher like we see in the United States. And earnings growth is the primary driver of shareholder value. That's something we're heavily considering when we make investment choices as to where we're allocating capital. And we're just not seeing that there yet. So that's something we want to keep an eye on. That's why we're not allocating 30% of client capital into international stocks, the Eurozone, and so forth. Yes, we're seeing some strong earnings in China, some in emerging markets, very little in Japan, pretty good in the United States, but not enough for us to. I do believe across most of our portfolios, we do have. We're centered a little bit more around domestic U.S. equities, and I still think that's where we want to be. But I think it's I wanted to address what we're seeing globally, just so you have a sense of what's going on throughout the global markets and why we aren't necessarily chasing those returns at this time. Furthermore, we've got regional conflict. A couple of years ago, we saw the conflict between Russia and Ukraine emerge, and just recently we've seen a steep escalation in the conflict between Israel and Iran, seeing missiles traded and bombings and so forth. That's escalated quite quickly and alarmingly. Markets have largely been shrugging that off. I wouldn't have been surprised when I saw the headlines of the Israeli strikes on Iran. I wouldn't have been surprised to wake up to see a 5% sell-off in markets. We're not seeing that. That's a little bit probably because Iran has been so segregated from the global economy for so long because of sanctions and so forth. So they aren't necessarily a large supplier of energy to the global economy like they might have been 15 years ago or so forth. So, but that's a concern. Obviously, regional conflict, the conflict in Russia and Ukraine, and then now between Israel and Iran are things that we're keeping an eye on because we don't want to see regional spillover, and that could affect the broader economy, if more countries are pulled into that conflict. So I know that's a lot. Again, Jarrod, anything else you want to highlight there or add to that?
I made the comment as we were getting ready for this. In investment, all roads lead back to diversification. So being able to have reasonable exposure to a variety of asset classes, knowing that you're going to get periods like this where you get outperformance in an asset, and it's probably not going to be durable, right? So I don't know that I would make a big bet that the Eurozone is going to continue to outperform the remainder of the year, because the things that are driving that outperformance are likely temporary. Very similar to how we look at commodities. You'll have periods where you get price movement inside commodities and you get drastic outperformance for 3, 6, 12 months. And then it kind of regresses back to the normal return, which is pretty non-compelling. So the same thing with, developed market ex-US, Eurozone and Japan returns where they have been and where we still project them to be. So I think it's a great call out. and it takes you beyond the headline, right? Where it says, hey, the Eurozone is way outperforming the US so far this year. Yes, but I think is the
Right.
comment there. There's some other things driving that. So we'll continue to be vigilant about any, reorganizations to investments and, target allocations and things like that. But I think that's a great overview of why we're not really seeking to make any big changes currently.
Yeah.
Um, so as we kind of, head toward the wrap up, and I know we're a little bit long today, but lots of detail that I hope was valuable and useful for all of you. Tim, would you have any parting thoughts or comments before we sign off?
No, no. I think there's a lot. There still remains a lot of uncertainty, particularly around tariffs and trade. We still have a lot of uncertainty around what the final tax policy is going to look like. And I know we sound a little bit alarmist when we're talking about the debt. We don't mean to be. We just mean to express, admittedly, a little frustration that this is not being addressed in the meaningful way that it should, but also telling investors what could be down the line potentially if we continue on this path. So we don't mean to be alarmist, and we're not calling for immediate changes to client portfolios, but we do want to stress the importance of this issue and just stress how untenable it is over the long term. But we still do see a very strong economy in the United States. We haven't seen inflation pick up despite the expectations of inflation rising due to tariffs. So earnings have been very strong. The labor market has been incredibly resilient. So a lot of positives for the U.S. economy, and we don't want to lose sight of that. So I think I want to end on a positive and just say there's a lot that we do like going on in the U.S. economy and in the U.S. stock market, and of course in the global stock market. So I think I'd leave it there and just end on a positive note rather than dwell on debt issues for the remainder of the day.
Agreed. And I think just to piggyback on that, we've said this all along that these are math problems that are eminently solvable, and we just sort of need the mutual agreement that we are going to take on some pain to be able to solve them. So either we'll agree to do that collectively, or the bond market is going to not so subtly nudge us in that direction. But those are all solvable challenges. The underlying fundamentals of the global and U.S. economy in particular still look really strong. So I think as investors for this year and next year and beyond, we still feel really great about having capital at work, generating rates of return, all of those things. So well, thank you, Tim. Thanks for
Yep.
such a great discussion today, and thanks to all of you for giving us some of your valuable time. Please don't hesitate to reach out to us if you have follow-on questions or requests for future webinar topics. We're always interested to learn and deliver better information so that you can make better decisions. So thanks
Yep.
everyone for your time. We appreciate you.
Yep. Thank you, everybody.